Want to know how to separate average suburbs from truly investable market? In this video, I'll break down the 4 key layers of property market analysis that every smart investor should use. From demand and growth indicators that are core to the search process, to the risk filters, the affordability checks, and finally those important fundamentals that most people miss. Hi everyone, my name is Nick. I'm a director here at Handle Properties, and I'm a buyer's agent for property investors specializing in residential properties between $400,000 and $1 million. My business partner AJ and I have helped over 80 clients buy investment properties in this price point, and we've personally built multi-million-dollar property portfolios ourselves north of $5 million, all while working corporate jobs and while on single income. We keep it real and we focus on data-backed decisions that actually move the needle for long-term performance and growth. And today I'm going to show you how we assess markets before we even consider recommending them for clients. So let's dive into it. The first step before getting started is to understand the strategy and the investment brief. This is the key input to how we analyze the remaining layers of finding the right suburb. The first step is to understand what entity are we buying the property in. Is it in your own name? Is it in a super fund? Is it in a trust or another company structure? That's super important. Then we need to understand what is the hold period or time frame before you need to sell this property. We also need to understand when do you want to extract the equity. So what is the strategy? Is it a quick equity strategy? Is it a long-term sustained equity strategy? Whatever that may be, that will all be inputs in terms of what suburbs we select. And finally, we need to know what is the maximum budget, not only from buying the property, but also from owning the property. So the first layer of finding the right suburb to invest in is to focus on the core growth and demand indicators. The first one is days on market. This is how long properties take to sell. If homes are selling quickly, that signals strong buyer demand. So therefore, you look for a decreasing trend and ideally under 60 days on market, preferably around that 30-day mark. The next data point is sales volume trend. This shows how many properties are being sold in that particular region. A rising sales volume tells us that the market is active and the data, importantly, is reliable. However, if sales are low or dropping, the market may be stagnating or there just simply isn't enough data for you to make a statistically reliable analysis. The next data point is price growth trend. Are property prices going up? And at what pace? If they're steady or accelerating, that is what you want. You want to focus on these markets. Avoid markets that have recently peaked or are showing signs of decline. Next, you want to look at vacancy rate. This tells you how tight the rental market is. A low vacancy rate means demand for rentals is strong. So look for areas that are under 2% and ideally in a declining trend. So they might have been 3 or 4% a year ago and now they're 2%. That's good. You also want to work on your gross rental yields. This is again a function of your investment brief, which takes into account the entity, your buying budget, as well as your hold period and time to extract that equity. But the gross rental yield measures return on investment from rent before all costs. And it's important for comparing cash flow across different markets. In our analysis, we generally start our search at 4 to 5% yield or more if you're buying in your own name, because you do get some tax benefits. But if you're buying in other entities such as a trust or a super fund, you need to be aiming for 5.5%, 6%, 7% or more. The next is rental listings trend. This shows if supply is shrinking or growing in the rental market. A decline in rental listings over 6 to 12 months signals tightening supply, which supports net rental growth. You also want to be looking for the supply pipelines. What are the development approvals that are coming through in that particular region? This is an indicator of new stock that is planned for an area. And typically, more supply or more stock coming into the area will suppress capital growth, subject to demand being the same. So obviously, if there is lots of supply coming in, but there's lots of people coming in that outweighs that supply, prices will continue to squeeze upward. But in general, focus on areas with low or declining development pipelines, and also be careful to distinguish between approvals and actual building starts, because not all DAs get built, especially in the current environment where construction costs are really expensive. So once you put in your core growth and demand indicators, you might be able to filter down from the 15,000 suburbs in the country to the top 200 suburbs. Now you want to be filtering it down even more by layering upon your unique risk and volatility indicators. The first one is industry diversity. This is where you want to make sure that you are not buying into an area that is reliant on incomes being made in only one industry or two industries, such as mining or agriculture. These typically are your smaller mining towns or regional towns around the country, and they are more vulnerable to job losses, changes in cyclical commodities demand, as well as broader demand shock. Avoid markets in general where 50% of the jobs are tied to a single sector. The next risk layer to overlay is flood and bushfire risk. Properties in high-risk zones cost more to insure and are less attractive to buyers and renters. You don't want to be buying in a place where all of a sudden the insurance costs can go from $2,000 a year up to $10,000 a year. And that's very common in some parts of North Queensland. So always check the risk maps, such as flood maps and bushfire maps, and either avoid or price in the risk carefully. The next risk layer is the volume of sales. This aligns more to getting statistical accuracy in your analysis. You need a decent number of sales to rely on the market data. So be wary of places where there's less than 50 sales per year, because it can lead to misleading trends. And of course, be cautious if the sample size is too small, and understand why that might be the case. Now you've gone from your 15,000 suburbs layering down to 200. With your risk and volatility layers, you might be able to get down to your next 50 suburbs. And this is when you start wanting to layer upon the affordability and demand layers of your analysis. And these are really important for the long-term growth ability of that property. This layer looks at whether local populations can actually support population growth and property growth, and whether investors are active in the area. So the first data point here is the affordability index. This is simply a function of how long it takes for the average family with the average income to pay off the average mortgage in that area. You want to look for areas where it takes less than 30 years to repay the median mortgage. More affordable areas tend to have more buyer depth and stability. And of course, if it takes less to repay the mortgage, you'll have more people that are willing to upgrade and renovate and maintain their properties, which again leads to higher capital growth. The next data point is income versus price ratio. Similar to affordability index, but it's a direct comparison of today's property prices against income. A lower ratio is better. It definitely means that people in the area can afford to pay the mortgages and can afford to pay the rent relative to their wages. The next data point is the owner-occupier versus investor ratio. Generally speaking, all of Australia has about 7 in 10 owner-occupiers, while the remaining 3 in 10 houses are rented. So what that basically means is that owner-occupiers are the ones that drive up property prices. So you want to be focusing on areas where there are more owner-occupied. That is where we prefer to look for areas with more than 50% owner-occupiers, but most of the time we're buying where it's 60 or 70%. The next is the socio-economic index. Higher scores here mean a more better socio-economic advantage. These areas are often more resilient and more likely to gentrify over time. A higher score generally means a higher or better long-term outlook. And we'll dig into this in the next layer when we go through the non-data points. But if you feel that an area, for whatever reason, can transition from a low socioeconomic area to a higher socioeconomic area, that is also going to make your property ownership experience better, because those fast gentrifying areas have the ability to pay more for housing. So now you've gone down to your 50 properties, and now you've shortlisted the top 20 by layering upon the affordability and demand layers. So how do you go from 20 to the top 5 areas. This is when you have to start having that nuanced approach that doesn't necessarily require blanketly following the data. Because again, data is just data. You need to have a fundamental analysis of what's happening on the ground. So the first thing to check for is infrastructure spend. Look for where governments and large private enterprises are spending money on big projects. It's easier to follow the money and ride the momentum. So think about roads, hospitals, schools, commercial buildings, and large shopping centers. These are all large investments made by corporates and government that will lead to long-term stability in an area. For example, if a government has committed to building a large hospital in a particular area, that project might provide 5 to 10 years of solid construction jobs and construction adjacent incomes to build that hospital. Once that hospital is built, you then have an influx of nurses, doctors, medical technicians, and hospital administrators who are all reasonably well paid to come into that particular area and would want to live close to where they work. That again further diversifies and increases the local economy and encourages spending on housing in that particular area. So follow the money. The next is gross regional product. This is a measure of how much economic activity a particular region is generating. Similar to GDP for the nation, but this is for a particular council. So use platforms like RemPlan to check this. It's completely free and we'll have a link in the description below. Look for consistent GDP growth in a particular region. You want it to be growing, but then also deep dive into the GRP growth per capita. You not only want GRPs growing up, but you want the economic output of every individual person in that region to be quite high. And it's amazing to think that the GRPs of some of our capital cities are just as large on a per capita basis as some of our smaller regional towns, which also proves that buying in capital cities doesn't necessarily mean long-term capital growth and rental growth, as the economies of these smaller towns on a per capita basis are just as amazing. Another very nuanced data layer is value or value for money. You want to be buying in places where the product or the property that you're buying actually represents true value in today's market. Either you are buying it below replacement cost or it has been renovated and kept neat and tidy, that's not overcapitalized on the cost either. This is super important in regional or fringe areas, which can not only be an indicator of a good deal, but also it allows for the value. Now, this is super important in regional or fringe areas, and it can be a great indicator of a good deal. The last data point is rental yield compression. So you want to be looking for areas that are trading with rental yields above the average for that particular region. And it'll start attracting more owner-occupiers, investors over time, and those rental yields will compress. That means rent stays stronger, but prices rise faster, which is great for capital growth. Now, adding on this next level of layers, this is how you can completely reduce your search from 15,000 potential locations around the country to 2 or 3 investable suburbs that perfectly match your investment strategy of what entity you're buying the property in, the hold period, when you need to extract, and your total budget. So there you have it. Here are the 4 core layers of property market research and then all the underlying data points that you need to look at. When you stack all of these layers and data points and nuanced fundamentals together, you get a far more complete picture, and you're much more likely to invest in markets with real long-term potential, and it mitigates the risks of things going wrong. I'm Nick from Handle Properties, and if you want help finding data-backed investment locations or want to work with someone who will do this analysis for you, get in touch. We'd love to help you buy smarter. Thanks for watching and see you in the next one.